So the POMS were at it again overnight. Firstly, last week or last Friday, we had the mini budget, which sent the markets into a tailspin. And then last night, the Bank of England came out to shore up the long end, the 20s and 30s, and that's more about leverage and all the margin calls that the superannuation funds, or what they call pensioner funds, use the long end bonds to hedge their interest rate risk and death benefit risks, and they were getting called on margin calls. So whilst the Bank of England is raising rates in the short end, they've now gone back into quantitative easings on the long end and purchasing bonds in an effort to drive the long end of the curve back down. And the whole market, as you can see here, this is the US government bonds, but that affected the global bond market. As we can see, the US turned around, as now everybody's thinking, well, perhaps we are at the peak, because everything's sweet. We've got free money again, and we saw a massive turnaround in the dollar and that risk scenario, and we saw stock market loved it big time, massive bounce, and VIX, the fear indicator, also turned around massively. So at the end of the day, I think what the Bank of England did is a limited scenario, a temporary fix to shore up their economy, and I think it's a localized issue. Broader picture is that inflation hasn't been resolved. Interest rates in the short end, i.e. the overnight interest rates, the 2-year interest rates, the 5-year interest rates, will continue to rally. The back end and the peak of the economic cycle hasn't been reached. So I think this knee-jerk reaction by the stock market and the bond market won't be sustained for a long period of time. I would use this as an opportunity to get into that concept that I've been talking about all week, is having that retracement and then getting back onto the bid of the US dollar, having that retracement on the pound and getting back onto it, because the systematic issues that were there yesterday are still there today. And whilst the Bank of England's move was primarily focused on the 20-year gilts and the 30-year gilts to shore up the liquidation of pension funds, that is not resolving the broader issues of inflation and global growth heading into a recession. And to shore up that, you're going to have to raise interest rates to curb inflation, go into a recession, and come out the other side, and that's going to be at least a 2-3 year cycle. So the systematic issues, I think, of the Bank of England is a localized issue and should be used as an opportunity to buy the dip on the US dollar, or to fade the stock market when as it rallies. We're looking for it to roll back over and fading that. Just quickly coming into commodities, I haven't had a chance to have a look at it, but a bit of a minor bounce there on the commodity index and copper, as that kind of euphoria of the moment takes hold, but it is exactly that. It's a short-term euphoric moment, and it won't be sustained. Anyway, all the best with it, guys, and we'll see you next time.